Well, I mean, as you know, this webinar is mostly designed to, for one, provide some practical tips, for two, also to be helpful to people who are about to thinking about or want to make their investments better. So I am happy to customize this in any form or shape. Please feel free to ask your questions in the chat or through voice. Naturally, we also as a group can take it where the questions lead us. Yeah, there is, as you can see, about, I don't know, 60 charts that I have for today's session. But we, of course, also can discuss, how would we say, more imminent topics or open questions. Ultimately, it's here to be useful for you. Wonderful. With that, thank you so much for your active participation, and keep that up as much as you can. So those of you who don't know me, my name is Olga Miller. I'm the co-founder of SmartPurse, and I'm an ex-banker. I spent about 12 years of my career in UBS and ended being a managing director there. And from there detected that people, women in particular, kind of have quite some hesitation when it comes to all the money affairs, and embarked, after piloting and testing financial literacy from and within the bank and to the clients of the bank, embarked on becoming an independent and building a venture called SmartPurse to bring impartial financial literacy to people, mostly women, but also now people of all genders, and also young people. And so with that, I started to teach money, write about money, talk about money, social media about money, and basically just am super passionate about both investing as well as all aspects of personal finance, and of course, all kind of content creation when it comes around or to the thing of passing it on to people. And I love humor. I also love kind of taking things more lightly. I love experiments. So in that regard, please really do not shy away from asking any questions. I'm very happy to share also my own mistake. Just one has happened last Thursday. I will tell you all about it because I firmly believe that nobody knows everything about money. Nobody knows everything about investing. We are all learning as we are testing this out, and actually we are learning every day. So with that, there is no magic recipe, but what there is maybe a couple of common pitfalls, tips and ideas that might be helpful for most of you to be aware of, but also to learn from the experience of others. And with that also comes the invitation to you. Please do not hesitate to share what you are invested in, what stocks you like, why you like them, because ultimately, as said, there is not the one single golden truth when it comes to this. Cool. As you can see here, one of the biggest obstacles that I find keeps people kind of back from investing is this magic thing of pushing the button. And I don't know if any one of you actually feels this, but I think there is so much emotion linked to pushing that button. Am I too early? Am I too late? Is it the right thing? Should I have pushed the button and sold earlier? Should I have bought earlier? Will the price go up? Will the price go down? What can I do with this? Should I go into crypto or not? Or maybe in the case of some of you who are also investing in startups, you know, is it the right startup, right? So it's an emotionally loaded action. And this emotion actually comes back every time when we invest. Even for me, it does. Of course, it very much depends on kind of what I'm choosing to buy and what I'm choosing to sell. But investing in itself is an emotionally loaded affair. And that is what makes it actually also so difficult. You will see later on that the majority of investment mistakes are not linked to wrong analysis or to not knowing what to do. The majority of failures in investing are linked to emotions. And my job today will be to shatter some of these myths and help you hopefully to find the tools to be more rational. And with that, also inviting you to use all the free resources we have on SmartPurse. We have a great app where you can find a lot of free stuff. Also on the internet, over 200 blog articles, videos, whatever have you. Please make good use of that. We're not putting that out there for our own amusement, but we're basically putting it out there so it's helpful to people. And in that regard, your feedback is also very much welcome. So today, we're going to touch on why investing is essential, what to think about before you start, and this also will be helpful when you already have started. Some words around funds, ETFs, and online providers. I would love to show you how you can build a strong base, a so-called all-weather portfolio, and from there then start breaching out into experiments around, be it single stocks, be it crypto, be it angel investing, be it crowd investing, right? But it's actually the base that makes up for 70 to 80% of an average person performance when investing. So it's good to put some time behind this and then touch on some of the common pitfalls and mistakes. And yeah, hopefully we will all have an enjoyable evening. Now, let me follow through with a question. We already touched on who of you invests, but maybe the people that feel that are not an investor, or do you feel you are an investor? And those who already answered, maybe you could be a little bit more specific. It's like some single companies or Swiss funds. Please be more specific. What do you invest in and what are you passionate about? And also those people who might be doing nothing yet, maybe say so as well, because this will make this a little bit more fun. I am curious to learn about you, as you can tell. Huh? This is not a monologue here. It feels very lonely when it becomes a monologue. It is so boring, really boring. So please talk to me. Structured products, okay. Cool. We had a session about this yesterday with Serge Nussbaumer. And then the other people. What is it that gets you out of bed every morning? What companies are you passionate about? Who of you has Apple stocks? Invested in Tesla? Okay. Kühne und Nagel? Okay. Zürich Flughafen? Yeah, they had a good run recently. Roche and BKB. Fun. Somebody lost out? Okay. We will reinstall that confidence. Tech stocks, okay. Cool. Nvidia, okay. Still holding on to that Nvidia, yeah. All right. And Bitcoin, okay. And sustainability and technology. Wonderful. So it is exactly this passion and interest that makes investing actually exciting. Yes, you will see that one can go at this kind of with what I would call the plain vanilla approach. And actually, there is absolutely nothing wrong with that. Yeah, there is nothing wrong with that, with putting together an all-weather portfolio and basically just investing every month and not thinking about it too much. But the excitement, of course, starts once you start to factor in the themes. As we heard, some people passionate about sustainability, some people passionate about certain companies, right? This is where you kind of add the spice and where you also feel the thrill. By the way, all of you are investors, because I would assume that the majority of you here has a pension fund. The pension fund invests money on your behalf. So even if you might feel that you are not actively investing, actually you are. And with that said, also to kind of have a look at what your pension fund is doing and what revenues it's producing is certainly a very good tip. Why? Because we always think about investing with the money that's in our direct control. But for the majority of people in Switzerland, the pension fund is actually the largest sum of money that is in our possession. Not necessarily in our direct command, strictly speaking, but in our possession. So it's very important to have a look what is happening with your pension fund. Why would we invest in the first place? Well, there can be a variety of reasons. One of the most common ones is to make that money grow faster than it would grow on a savings account. Already Einstein kind of spit out this wisdom that the most powerful force in the universe is compound interest. I guess that goes for many things, not just money. Of course, kindness can compound, fitness can compound. It's a little actions in your life actually can compound too, not just the money. But what you see here is basically the very simple comparison that I'm sure you will know and you will have heard of many, many times. Linear saving in the blue line, which also will make your money grow. And I think people had huge hopes kind of for the interest rates, right? The chronic savers had huge hopes for the interest rates to go up. And they did for a little bit until they didn't. And now everybody is already screaming for the lowering of the interest rates. Keen and eagerly awaited the statements of the ECB coming this week. And on the 18th of September, finally, we will learn what's going to happen in the US. In Switzerland, we already have seen 2 rounds of lowering interest rates by the Swiss National Bank, right? So we already, again, are in the environment where basically saving is just not good enough if you want to make your money grow, okay? It only can get you as far. And investing naturally gives you money the chance to grow with this red curve. And that is what we all want. Not that accumulating more money would be the sole purpose of doing it, as already said, right? Depending on what you are investing in and how you are doing it, it also is a very strong expression of your values, right? If you support, for example, startups, or if you put that money to work at disposal of companies that are changing the planet more sustainably. You see here, basically this saving versus investing comparison. Sorry for the typo here on Swiss francs, but really it's simple math. 100 Swissy monthly for 10 years, put down on a saving account, okay? And I actually took quite a generous saving rate here, interest rate of 1%, which in the past years, very few saving accounts, if almost none, haven't seen. And kind of the inflation adjusted investing also here, you know, taking the SMI performance here roughly 8.65%, and you kind of see how this has worked out. Of course, now this year has been so far a great year for everybody investing, but I think the picture speaks for itself. And that said, you don't need to put a lot of amount into your investing approach. Linking to the act of compounding and the small actions, also smaller amounts can work wonders. I don't know who of you has kind of a roundup saving or a roundup investing function. Investing, for example, you pay for something and then it rounds up to the next franc or to the next 5 francs, right? These automated habit changers or habit aiders actually can get you a long way. I give you an example. I use Revolut in the UK when I'm in London. It's not a lot of money I spend there, maybe 300, 400 pounds every month, okay? So it's not like largest sums of money, but I always used a roundup function. And in 2 years, I accumulated almost 500 pounds, as if I had found them, right? Revolut doesn't auto-invest this money, so it was just sitting there. But imagine if that money is being invested. So you don't have to be super wealthy to start accumulating. And one thing to be aware of is that, regretfully, there is no free lunch. The saving account keeps your money safe, and you will sacrifice growth for this, right? If you want to make returns, the more returns you want to make, you will need to assume a certain level of well-calculated risk, okay? No risk, no return. It's as simple as that. And there is no such thing as a risk-free investment that would provide a super high return. And I really do not get tired of talking about this to people, because the amount of scams and fraud, especially when it comes to kind of the digital money, that we have seen has increased so much, also in Switzerland, with so sophisticated methods, using fake advertising, using fake personalities, using all kinds of recommendation, using schemes where first it really functions, it holds its promise, and it gives you some money back until you lose everything. So the amount of fraud and scams has skyrocketed. If you come across some investment promise that promises fast returns at a moderate or limited risk, please look 3 or 4 times. I really by now know of people that come to seek my advice who lose 30, 50, even more thousand on such scams, okay? Especially also older people, okay? So really, I just, as a word of caution, if there is one thing you take away from this evening, please beware of these scammers, because they are getting more and more sophisticated. And how would you recognize this? The first warning sign is stuff that promises fast return at a limited or moderate risk. What influences the risk? Time. The more time you have, the more risk you can take. The mix, the composition of your investments, the broader the base, the better, at least when it comes to a risk perspective. And the most important thing being your own mindset. This is what I mentioned before, and we will see in a minute what it actually means. So I'm just quickly pausing here to see whether you are all already sleeping, or whether you have any questions around risk, return, and kind of this basic stuff here. Anyone, anything?
Excellent, Olga.
Or any comment?
We're awake, thanks.
You are still all awake. Okay, thank you so much for this encouragement. So let's look at the things before you start, or if you have started, if you actually have everything in place. First and utmost, wide awake and really clear. Cool. So 4 things that are really good to have when investing, regardless if you have already started or if you are about to starting out. First and utmost, it's good to know your money personality and your personal risk appetite. Okay, and we're going to unpack that just in a minute. Naturally, knowing the amount, how much you are willing to invest, how much you are prepared to lose as well, and having some form of a budget that doesn't have to be a super sophisticated budget, and a safety pot, a so-called rainy weather, rainy day pot, is extremely helpful. Knowing what teams you are passionate about, we touched on this, and what directionally you want to invest in, and then ultimately what you need. People always speak of this one tool. I would actually argue it's a suite of tools, because depending on what you are investing in, naturally you will be using different tools. And you can end up like Olga, who at one point at her peak had about 20 different investment tools. It was a little painful to keep the overview, and it was extremely painful when I had to do my tax declaration, because I had to download and search for all the tax statements from all of them. By now, I have managed to consolidate myself to roughly 6 tools, or I think it's about 7. It doesn't mean that you need to have 7 tools, but it kind of directionally shows you where this can go, right? So let's look at you. What type of investor are you? The cautious kind, the bullish kind, right? the considerate? Let's find out. So we already looked at this magic triangle, right? And we established that basically, no, you cannot have it all. Great return, low risk, and having your money readily available. And that there is no risk return. However, we come here to basically say, okay, how willing are you to accept that your money might get lost for the promise of a potential future return, right? Because the more risk you are willing to assume, in theory, the higher your return should be or could be. Of course, the risk is that the return will never materialize. But basically, if you put yourself somewhere here on this continuum, on the so-called risk-return chart, what you will do is, okay, if you want to play it super safe, you will put 100% of your money on a saving account, right? And if you come to you, Brigitte, just in a minute, if you want to have a great return, you will put 80 to 100% of your money into risky assets. Some of the riskiest being stocks, crypto, certainly, and then some alternatives, right? And then you have all the stuff in between. And let's open the floor to you, Brigitte.
Yeah, it's more hopefully for others too. One of the things that I always wonder is how much, let's say, of my 100% do I want to put in each of those categories? Are you recommending that we kind of say we are in one of those, or this whole thought of how much do you want in the low risk versus how much are you willing to put in the very high risk?
Okay, so it's an excellent question. Thank you for this question, really. I have 2 points on this. One is we all have a certain money personality and risk profile. Okay, and that risk profile, if you, for example, are like me, somewhere between the balanced and ambitious investor, okay, that is also reflected kind of in my financial personality, will shine through on all your approach to investing, one way or the other. Of course, you can kind of overcompensate it and move more towards the careful side. What will happen is you might feel a little bit bored, or you might kind of feel uneasy. You also can kind of overcharge it and move towards the super ambitious side of things. And if you were to do that with all your money, naturally, people who are balanced or between balanced and ambitious, or even cautious, and they move to the right side of the spectrum, so the very ambitious kind, they will feel very uncomfortable. And many mindset-related errors can happen. So you have this predisposition, which this is why it is so good to know where you see yourself. And then what I will show you later on, of course, starting from this predisposition, you kind of can put pots of money aside where you go a little bit more on the cautious side, maybe, or a little bit more into the risky side. Excuse me. And I personally really would do it by the purpose of the money. So, for example, having a speculation pot, okay, or a startup financing pot of 10, maybe 15%, 20% of your total wealth can be a great idea for you, right? If you are, let's assume, a balanced investor, you will have your baseline assets invested in a balanced mode, because why should you go the careful side, right? And then you will put together a pot of money that you use really to go into the riskier assets, 10, 15, maybe 20%, right? So I will show you later on a chart where you basically can kind of determine it by the type of money. Okay? Cool. So let's see where people see themselves. Balanced to ambitious. Very good. Perfect. So this is one way how you can find out where you are. And then if you want to take a more sophisticated approach and really test your financial personality, two things to know. One is, by default, Swiss financial services providers have to do some form of a risk assessment with you by law. Okay, the FINMA mandates them to do that. And the more unbiased, I would say, tests that you find here from University of Missouri or from Get Smarter About Money are just very interesting. If you really want to get to the bottom of the soul, I recommend to do more than one money personality test. Okay, it's quickly done and it kind of shows you where you are and gives you different perspectives. When would your money personality change? It can happen that you make a lot of money. Okay, that might not necessarily change your money personality, but you might be able to afford more risk because you have more wealth at disposal. Your money personality also can change when you get married, when you have children. For many people, their attitude to risk changes significantly when they start a family. So they are certain when you lose your job, maybe, but when you lose your job and then, for example, get rehired, that's too short of a time frame to readjust all your investments. Your mind will catapult you back to your kind of naturally given money personality. I recommend to retest and redo your risk profile about every 5 years or so when something in your life changes as well, but otherwise something like every 5 years. Or those of you who want to be more thorough, do it when you are kind of looking and revisiting your whole investment approach. Okay. Yeah, when you become an entrepreneur as well. Yes, there your attitude to risk changes significantly. Thank you to that. By default. I, however, have to say stepping out of my managing director job has not necessarily changed my attitude to risk. I think it just made me a bolder investor. Well, now let's come to these money mindset errors. Why is this important? Look, various studies, and actually one I really like, by Professor Hans from University of Zurich, who has analyzed over 200,000 trading accounts, okay, on Switzerland's largest trading and broker platform. And he has come to the conclusion, or actually they have found out, that riding the emotion roller coaster when it comes to investing costs people 5% of performance. So this is the trick your money plays on you. Imagine 5% of performance by just market timing being one thing. So trying to find the most accurate point in the market, or maybe never starting to invest. Loss aversion bias, a terrible thing, which says we fear losses more than we appreciate gains. And therefore, this feeling puts us into irrational behavior. Information bias, very prevalent at the moment. I can speak to you a little bit what's happening on the markets, right? The markets are highly driven by emotion. And what we currently see happening on the stock market, especially in the US, is highly driven by emotion, uncertainty, right? Uncertainty, which is de facto making people being super cautious, potentially being irrational, potentially sitting things out, right? So emotions really move whole markets. That's why a period like we have now, and that started sort of in August, where there is a lot of news, a lot of daily news, more news to be expected, such as the European Central Bank now coming, right? Such as the quarterly results of some companies coming, such as the Fed announcement coming, and the US election is basically causing a roller coaster on the markets. Okay. And I will give you a very good example what not to do from my own basically mistakes. So last Thursday, before the announcement of the US labor market statistics and how many jobs were created, I thought, I'm an optimist. Come on, these figures going to be good. I'm going to buy some more stocks this evening on Thursday night, because when the figures are good, I probably can make like a short-term tiny profit, right? So off I went. Other people go shopping to the store. I went shopping, you know, Thursday night with my mobile phone. Without a lot of analysis, I was more like, okay, let's try this and let's try that. It wasn't a lot of money that I deployed, about 3,000–4,000, but still it was not nothing, right? Friday comes, I'm like, let's have a look at this stuff. I started in some plus, started to look good. Friday morning Swiss time, the announcement came and down it went in the red. Okay, I couldn't have put on a redder dress than that. Okay, $500 gone, $600 gone, $800 gone. All right, it took, quite frankly, all my mental stamina to kind of sit down and say, okay, let's do proper analysis, and maybe let's just do nothing for the day, which I did. Okay. On Monday, the portfolio started to make up a little bit of its losses. Today, it's already looking better. Okay, so maybe I will get out of this with kind of one blue eye and losing maybe a couple of hundred. And maybe if I have the time and kind of the patience to sit it out 2 years from now, one will be laughing about this. Why am I telling you this? Because it's such a classic example of trying to time the market and even doing it badly without proper analysis. Okay, emotions got ahead of me. Okay, and the second thing that you see here, the top kind of bias that can occur, overconfidence. Okay, I've been studying these markets, been studying these news. I've been investing with single stocks and all kind of stuff for a very long time. I thought, you know what? It's been a good rally. It's going to continue like this. Okay, the markets are the markets. They don't have to do anything other than to exist. So I hope you take some inspiration from this story. And let's move over to see some person has a comment here. How does it look now? Yeah, I think it's looking much better. Now it's about 200. I mean, the overall portfolio is still in the plus, okay? It's just that the daily P&L was so much in the red, so the newly bought stocks still are catching up. And I'm braced now, so let's look at how much. Well, you could use kind of simple math. One of the most common rules, 50, 30, 20, 50% of your budget being used for costs of living, daily expenses, etc. 30% for the wants and 20% for kind of your long-term financial planning. Yeah, it's easier to do it with a budget. And really, my recommendation is to do a very simple financial plan. Have a look at the money that you might want to put aside for your retirement and for your long-term goals, and certainly invest that money. And if you want to work with some averages, certainly there are national statistics from Switzerland. So you kind of can see here the saving rate of a Swiss household, according to the Bundesamt für Statistik, is roughly 1,710 Swiss francs. This is quite a lot. It's actually almost 20% of their disposable income. There might be periods in your life where you cannot save that much or invest that much, but a simple financial plan will help. And people very often ask me, should I deploy that money all at once? Or should I go at this staggered? That depends, as with many things. What does it depend on? First and utmost, if you have no large sum to deploy, then you will invest automatically monthly. And if you have a larger amount of money that you are looking to invest, in super difficult times like now, where uncertainty is high, certainly you are better off investing that money in a staggered way. So for example, in 3 to 5 installments. In calmer waters, research by multiple financial services providers such as Vanguard suggests that actually investing the whole lump sum at once will in the end work out better for you, especially if you invest for a time frame of 10 years or more. Okay. I personally at the moment choose the staggered approach. Why? Because it allows you to benefit from an average price. I also choose to invest in a staggered approach in highly volatile things such as crypto. Okay. So that question answers. And then what to invest in? Well, how would you or how did you find your investment ideas? Where do you go for inspiration? Let's hear it. Do you use a tool? Do you read the news? How do you find investment ideas? For those people who already are invested, how did you find those products, or what did you choose those companies?
Can I ask you another question, Olga?
Sure.
Because for me, the first decision point, once I am where you're saying, is, do I manage it myself or do I give it to someone else to manage? And
I'm going to come to that.
You're coming into that.
Coming to this.
At the stage, okay.
Coming to this when we come to the tools. Just
Okay.
bear with me.
Okay.
For another 5 to 7 minutes. Yeah. So finding investment ideas. Okay, colleagues, friends, news, combined with own analysis. Okay. Fachzeitschrift Bilanz. Okay. Cool. Seeking Alpha. Yeah, know that. Other apps like the Monthly Fool is maybe one's. Colleagues, word of mouth. Exactly. So one thing that you should be aware of is once something is already kind of broadly in the news, okay, such as it was, for example, with NVIDIA, usually kind of the news, the novelty of it is already priced into that stock. Okay, that's why when there is a hugely propagated stock and all the platforms already write about it, the upside might already be priced in. Okay. So what you want to do is to kind of use multiple sources. Sorry, my cable just dropped here. Use multiple sources and kind of look for the things that are more emerging. Yeah. And in that regard, one thing that I can recommend, and I'm going to type it into the chat here, for Swiss stocks, Obermatt. Obermatt is an analysis research firm. They provide very helpful stock analysis on the Swiss stocks. Okay. I also can highly recommend TradingView for those of you who want to kind of dig a little bit deeper and maybe also use more sophisticated charts. It's a very helpful tool. And then there is the monthly, I think it's called the Monthly Fool, which also provides certain stock recommendations. Okay. And then finally, I personally really also read cash.ch. Kind of like it, just to kind of complement this thing. So that's just for you to really use multiple sources, but some of the best investment ideas really come from daily life. Observing the products you like, what's happening in the daily life, products your friends like, things that might be happening, observing in your professional environment are really some of the most innovative investment ideas. Okay. Give you an example. You know, Planted Food, and I'm not talking of the company Planted, but Planted Food. 4 years ago, 5 years ago in Migros or in Coop, there was nothing vegetarian or very limited, right? And if you were observative, all in a sudden you started to see all these products popping up. Those who took inspiration to think about, hey, maybe there will be a whole new industry forming out of this that could be very interesting, those actually took a really good investment. Same, I think the example of NVIDIA is really brilliant, right? Because initially about NVIDIA knew people whose kids were gamers like mine. Okay, and they were like with the graphic cards and all of that. And then you kind of look at the company, you're like, where's this obsession? It's actually quite interesting. Maybe I'm going to put a little bit of money into this, right? So do not shy away from looking at companies whose products you use in daily life, right? If you love, like me, the iPhone, why shouldn't you have Apple stock, right? It's the most natural thing on the planet to do that. At least for me it is. So that, at least as inspiration. But that said, as we established earlier, it is all in the mix. And so I would love to kind of sharpen your senses that the very, I will say, broad-based, okay? You go, you buy a broad-based fund, for example, an all-world ETF, or you invest in the Swiss stock market broad-based, or you have a robo-advisor putting this thing together, kind of this broad-based here as the strategic allocation, right, makes up for roughly 70 to 80% of your performance, okay? And then you put your satellites on top of it, so the more experimental investments, the single stocks, hedge funds, structured products, whatever have you, what people already voiced here, right? And so this core satellite approach, I'm a huge fan of that, because we all know that the core, so the strategic allocation, it's maybe not very interesting, but it will get you there. And you can, of course, make really good return then also on top of that with the satellites. And just to kind of sharpen your senses to some of those trends, I think we've all seen it. Those of you who might be familiar, cannabis stocks, super fashionable about 5 years ago. Everybody was running crazy about medical cannabis and whatever have you. Somehow they have vanished from the landscape. Well, metaverse, land grab in the metaverse, right? In a digital 3D model, there can be scarcity of land. Not very logical, but okay, people believed it. NFTs, AI, right? And now already, when it came to the results of the tech stocks, right? Already the first voices, is the AI hype already over? Let's see if they can prove, right? And I think the most prominent example really is NVIDIA, who did deliver stellar company growth, perfect figures, and took a beating on the stock market when the share price went down. So just delivering stellar figures wasn't good enough. Investors were not convinced. Investors were not convinced that they can keep it up, right? So I think that's just to be aware that these trends and these news that we all get implanted into our head really should make a smaller portion, okay, on some examples. And now coming to Brigitte's point and the approaches how to do it, right? What is your style? You can get on about this, do it all yourself. Get an account on a broker platform, start buying stocks, start buying ETFs, get multitude of tools, investing in crypto and whatever have you. Okay, possible? You can get on this with help, right? So for example, you select an online platform or already that will structure the investment for you, or you select some prefabricated investment products. Give you one example of such a thing, what I mean by it. Invest Easy by Swissquote, not to advertise for Swissquote, but just to mention an example, is already a prefabricated portfolio that you buy into, okay? And you pay a management fee. I think 0.7 you pay or 0.73, all right? So that is what I mean with help. And then you can take complete hands-off approach and kind of delegate it all to an investment manager or an advisor. And in all honesty, and without speaking bad about my own industry, but I had many people reporting mixed results with that approach. Okay. Some also very good ones, but some also where I said worked and it didn't really work out. Fees were too high and it didn't provide those returns. So these are kind of your three approaches. And now, how would you determine what is right for you? Well, first and utmost, kind of the do-it-yourself approach gives you the most control. You are in charge of deciding what you pick, which is brilliant. And in particular for everyone who wants to invest sustainably or as sustainably as we humanly can, naturally it is the approach where you really have the most control. But you need to put down the time. You need to do more research, clearly, okay? And naturally, yeah, you need to feel and have the confidence to be able to do it. If you delegate, you might use an online wealth management online tool or a prefabricated product. Cheaper option is to use digital providers. The more expensive is to use the human advisors, right? When you are starting out, I recommend to start with the middle option, okay? And then work your way to the self-directed approach. But that's my personal recommendation. Just because you already are starting out, you need to gain confidence and you need to make the learning. So start with some easy tool or some easy to understand product and then work your way into the riskier, more interesting asset classes, such as crypto, such as single stocks, such as potentially even adding startups or hedge funds or then into derivatives of, you know, structured products. That's my personal recommendation. Okay. And if you already have this base, for most people, the natural way is to bridge from B to A. Yeah. Then just a couple of words around all these providers and the funds, etc. This, I think we already established. If you do everything yourself with single stocks, mind you, you do need to adhere to diversification as well. Okay. And there are different schools of thoughts and different theories. I choose kind of to believe the one that says you should have roughly between 50 to 20 different stocks, okay, in your stock portfolio. There are certain theories that says, no, you need up to 200, but then the portfolio becomes completely unmanageable. Naturally different also, ideally you would complement it with different industries. And I know there are some people among you who are like me, deep tech passionate. Yes, of course, we all probably know what we are talking about, but that kind of would be the recommendation here. If you select funds and ETFs by yourself, of course, the funds and ETFs will already provide a certain level of diversification for you, unless you choose highly thematic approaches. So I don't know, cybersecurity only, or I saw recently in summer a thing around soccer, okay, a huge soccer fund, which wasn't doing very well, but you kind of get what I'm talking about. You will get the diversification, but you still, of course, need to look after the fund yourself and kind of make sure that it still fits your needs and purposes. But it is an easy and good way. And if you are selecting a fund, note that there are two types, and it's one of the most common investing mistakes for people in Switzerland. They are funds that are being put together and managed by an active fund manager. And they are funds that are basically put together based on tracking the price development of certain companies or even whole markets, right, as you see here. So for example, you know, tracking the development of the 500 largest US companies, or the MSCI World has roughly, I think, is tracking the price development of 4,800 companies. Swiss Market Index, 20 largest companies in Switzerland. The Swiss Leaders Index tracking 30 Swiss leaders, etc. You get the picture, yeah? And the huge difference, and here you see an example of the Swiss Market Index and the companies that are in it. Sorry, maybe one thing you should know about this is that it's dominated by 3 giants that make for about 60% of the whole index. Okay, so it's not as diversified as you might think, even though there are 20 companies in it. That's just one thing to note about the Swiss Market Index. But back to the funds. If a fund manager is involved and they put their skill and art and beautiful analysis tools into putting the fund together for you and managing it for you actively, then they will charge a fee. 1.2, 1.3, even maybe 1.5%. Okay? And these are the so-called actively managed funds. If the fund is using an automated tracking, such as, I don't know, tracking the Swiss Market Index, it's usually an index fund. And if it is traded on the stock exchange, it's an exchange-traded fund, a so-called ETF. These funds, because they kind of run on an autopilot, naturally are far more cost-effective. Okay? 0.2, 0.3%, 0.4, maybe. Yeah, so you see the price difference. Now, of course, you are not only after the price, you also are after the performance. Naturally, you would expect that the actively managed funds, where the investment managers put their skill and art and everything into it, would do much better than the overall market, right? Because why otherwise have it? Research has shown that that is very rarely the case. I'm sorry to be a disappointment here, but really. Whereas the passively managed funds, index funds, and ETFs, of course, can only ever perform as well as the composition or the index or markets they are tracking. It's in the nature of the product, but they are super cost effective. Now, Vermögenszentrum has done a beautiful study on Swiss, I think on about 5,000, 4,500 Swiss accounts, okay? They have found out that 73% had actively managed funds in them without people knowing. Because the banking providers tend to recommend actively managed funds because they can charge higher fees. It's been quite striking to understand that. So one thing that you should do is really to have a look at the investments that you have and see whether they are actively managed or passive funds. And if you want to save some money, I encourage you to try to look for a passive alternative, because in the most cases, there is an ETF out there that will suit your needs and where you will pay far less on fees. So that was the one thing that I wanted to leave you with, just because data suggests that really many people are overpaying out of nothing. Okay. And then Brigitte is asking, if you do D1I, do people usually a group of similar individuals like a book club? Yes, they do. Many of them come together in Smart Purse and after our courses. Yeah, this is where we have chat groups right now. We will have the investing in stocks course, where we show people technical analysis, fundamental analysis, and all the ins and outs about the markets. And we're going to practice as well. And naturally, then people stay on and they kind of become a group exchanging on investing. Even I am part of quite a number of groups, including trading groups. It's no fun doing it alone, okay? Because you are never sure, even if you are experienced, even if you're you are good with charts, you are never quite sure whether you are seeing the same thing as other people. You know, the mind can play tricky things. Then you kind of look at the chart and it's doing up and down and you're like, yeah, let's connect these two dots. And she's like, yeah, it's a great trend. And another person will say like, huh? I see nothing like this, right? So it's good to do it with others. So active versus passive funds. I think you have understood that. And then one last thing about funds is to be aware of the so-called thematic funds, right? So what are thematic funds? They are funds, as I mentioned, only in cybersecurity, or I don't know, only in precious metal, or only in, I don't know, the cannabis, yeah? And here is a very interesting research, and that's why I invite you to add these funds as kind of satellites on top of your broad base, because as Morningstar has researched, right, many of them do not survive and many of them do not provide great performance. You see here different time frames, and the percentage of funds in different categories, equity, fixed income, property, and allocation, the percentage of thematic funds that manage to survive and to beat the broad-based investments. And how would you read this chart? Basically, we see that here in the 15-year time frame, the equity thematic funds, only roughly 1/5 manage to survive and be better than the broad-based investment. Yeah. So that's why adding it as spice is great. Having it as your main investment might be very risky. Okay. In your file, you find some examples of so-called broad-based investments, the so-called World ETF, FTSE All World being one of the favorites. There also is a MSCI All Country World, MSCI ACWI is also one of the broad-based indices. These really are the big ETFs, broadly diversified, that allow you to invest in the planet. Mind you that the majority also on a world ETF is informed by US stocks because the big companies sit in the US. Okay, so that's one thing to know. If you want to do your investments with single stocks or buy ETFs yourself, you need a search platform. Just ETF is a very good one. And you need some form of a broker, right? Where you open your deposit account and from there where you buy the ETFs. Please make sure that you do not overpay by cost per trade, okay? The largest Swiss domiciled and Swiss regulated pure Swiss broker is Swissquote Bank, okay? But they also are alternatives. Interactive brokers, okay? For example, Coordinate Trader, etc. Where would you find a list of them? On Moneyland. Very helpful source. Okay. Cool. If you do it the easier way with kind of an online digital advisor, for example, as I mentioned before, these tools are extremely helpful, very reasonable. And one thing you have to know is that unless this online provider is also a Swiss regulated bank, like for example Alpian, or like for example Swissquote, or like for example Bank Vontobel, the fintech in itself does not hold your money. Okay, so if we take an example like, I don't know, Innova or Selma, they do not hold your money. They only manage and are the interface. Your money still will reside in a Swiss regulated bank. In many cases, it's Saxo Bank Switzerland or Hypothekarbank Lenzburg. Okay, so your money cannot get lost when the thing gets busted. It cannot get lost for two reasons. One, when it is invested, the securities, so their investment belong to you. Okay, so the bank goes busted, you take your investment with you. Number two, because the robo-advisor or online wealth manager uses a so-called custody bank, if they go busted, the underlying bank takes over. Okay, I have been in the board of such a digital wealth manager. The digital wealth manager went busted, nothing happened to the client. It was just embarrassing for us as a board that this had happened. Okay. How can you imagine, does this look like? Well, here is one example, and I'm going to come to some of these tools just in a minute. But basically, what does this tool do? It is like a shopping assistant, a management assistant. It puts a portfolio for you, right? And then also maintains its shape and form. Okay, so that is very helpful. But you pay a management fee for the so-called portfolio, right? And of course, you have less control, as mentioned before, because you cannot eliminate single stocks or single ETFs usually, right? It's like a fabricated thing for you, okay? But it's a super rather cost-effective and very time-effective way to invest. Okay. Performance of these online providers, research by the University of Lucerne. You see here, green, yellow, red, the performance of online providers versus the mutual strategy funds in dark purple. We all see on all risk categories, these online providers have outperformed the strategic funds. Why? Not because they would be so much smarter, it's just because they are so much cheaper. Okay, almost 2% is what University of Lucerne has calculated. So also there, not necessarily about the brain power, it's also about saving costs. Where would you find online providers? Again, on Moneyland, right? You will find and can download a whole list. I think there are about 18 of them in Switzerland. And I'm going to show you my preferred list just in a couple of minutes. And then finally, let's come to Brigitte's question, which is the right strategy for you objectives. We already looked at it, right? It's like this, you know, building wealth long-term, steady, with a broad portfolio and potentially making quick gains fast or adding some spice to it. One doesn't contradict the other, but what you will want to have is for different types of your investment, a different approach. And here is one way how you can look at it, right? The first thing is having a safety pot, roughly 3 months salaries that you will keep on a saving account. If you want to give it a little bit of a boost, you might want to consider to either put it on a saving account with higher interest rate or invest maybe 5, maximum 10% of it into something, either a broad-based world ETF or potentially into gold or into, yeah, I think probably the broad-based ETF. But we want this money readily available. Then naturally, some of us might have a property or a house, which is an investment in itself. And you have your employer pension. As initially said, please do have a look how your pension provider is dealing with your pension and what options you might have to actually influence that, because there are different plans available for different amounts and there might be some flexibility. Then you might have your private pension, which for many people in Switzerland is your Pillar 3A. And this private pension, you might have different pension pots. Okay, people can have up to 5 Pillar 3A accounts. And I, for myself, have this invested according to my natural financial personality. So in my case, moderately. Why? There is no reason to deviate. There is no reason to be afraid to invest that money. It's actually some of the longest money that will sit there until we all retire for most of us. So going with your natural financial personality, or what for many people is counterintuitive, but actually even more on the riskier side, especially if you have 10, 15, maybe 20 years to go, can be a really good idea. Then you might have the pot of funds for children. The money that you invest for your children. I started to invest for my children when they were 0, right? So for 18 years, their money has been invested. The funds of my children are invested in broad-based all-weather portfolios, broad-based world ETFs and the Swiss market index. Just because I would never want to play any games on their money, right? Let's assume you have some more money to invest, then it can be a good idea to put this into first an all-weather portfolio, as already said. So this can be with one of these online providers. It can be that you kind of buy into a prefabricated portfolio, right? And once you have all of this in place, then to start reaching out into thematic funds. These are your satellites, right? Thematic funds, crypto, single stocks, right? So probably your base will make 80% of your total wealth, and 20% will be kind of your experiments and the try and error experiments. Really be cautious with that. It's money that can get very easily lost. So I only have about 5% of my investable money readily available for try and error experiments. And by that, I really mean try and error experiments, such as I took last Thursday by not being a good citizen with my own mindset. I hope, Brigitte, that answers your question. And I hope this gives all of you kind of a structure how you could look at this. Crypto, people often ask, the basic recommendation is about 5 to 10%, unless you are an enthusiast. Yeah? Good. Now, finally, to conclude on all of this, some of the tools, the commonly used online providers that I have put them for you on kind of a continuum of starting amounts to invest. So you really see that it is very easy to start investing also with small amounts. I'm only going to touch on a couple of them. I think if you are looking for a super cost-effective, kind of easy to handle online provider just for investing, Findependent could certainly be a good choice. If you have a higher starting amount of roughly 8,000 Swiss francs, SheWealth can be a very good choice too, for an investment-only online provider. You have here these guys in the middle, Selma, Innova, Redicant. Innova predominantly focusing on sustainability, so they do everything with single stocks. Selma, yeah, I personally think that they are better choices now on the market, either with prefabricated products that are already issued by licensed bank, as already mentioned, Vontobel, Swissquote, etc. Or, for example, Alpian, right, which also is a licensed bank and is very competitive on fees. Redicant as well, but Redicant had a lot of bad press the past 12 months, changing CEOs, changing team members, etc. If you do not need to have a huge investment universe and you are looking for a really beginner-friendly tool, you by Swissquote and PostFinance, also a great choice. The only thing that is with you is that people have reported to me that it becomes too limited and too easy after about 2 years for them because they want to do more, their confidence has grown. So that's just one thing to be mindful of, but also a very good choice. Okay? Cool. So that gives you a couple of tips around tools. And again, as a comparison, the broker platform where you choose your own stocks, right? I use Swissquote and Interactive Brokers, but you find the list on Moneyland. Okay, and it really, you see, it's a very different story. And then finally, maybe one thing to leave you with is really my personal biggest investment mistake, besides not always controlling my own money mindset, is to sitting on too costly investments for too long before changing to something cheaper. Okay, changing these days from one tool to the next should be pretty straightforward. So start out with a platform, start out with a demo account. If you want to go into single stocks, start with small amounts, right? To gain confidence. And just be aware that also professional traders, people who do it professionally to make money day in, day out, have a trading plan, and the gains they make and are not like huge, making 100,000 every day, of course, unless you do it for a bank, as well as the risk you assume is very calculated risk, usually about 1%, okay, of the overall portfolio you are trading with, right, on one trade. So it's not like, you know, being more active on the market would mean instantly more gains, right? Also there, when I started trading, I started with 500 francs, right? Now my portfolio one is about 35,000, right? So it's different leverage, but when you get into it, you need to gain that confidence and you need to make that experience. That's one tip. And the other tip that I have for you is, my personal regret usually was, and still is, probably not having invested rather than in hindsight having waited. So as much as I was close to panic last Friday, so 3 days ago, already know what I know about the stock market kind of made me sit it out. And basically, it just means that I will have to be patient. Maybe I will have to be patient for a year. Maybe I will have to be patient for 3 to 5 years, maybe even longer. But then this was nothing to do to make a quick buck, or actually it was, if I admit it, but it turned out into having to be patient. And that's fine, because I don't need that money straight away, right? And that then also closes the loop on the safety pot. The safety pot is here to make sure that you are never in the position that you need to sell some stocks just because you need the money at a very unfavorable point in time. So I hope that with that, I managed to kind of inspire you and give you some helpful and handy tips, right? I think we touched on the most common mistakes already here. Really take action and be sure to check whether you are overpaying on your investments. It might be as big of a mistake as, for example, putting all of your eggs into one basket and cost you dearly. Cool. And with that, because this webinar is sponsored by Alpian and we also do SheWealth together with them, 2 things to know. As of last week, all accounts that are being opened on Alpian are free and they will remain for free. So that's kind of cool. So they used to charge about 300 francs a year for the banking account, and that's all gone now and will not come back. So now basically it makes it a very cost-effective way to invest, because you get a free account and on your investments you pay roughly 0.75%. So it is an offer that I'm happy to extend to you, because it also makes economically sense and it's competitive. And if you open an account and are not an Alpian client, you get a cash bonus, okay, of 200 francs. So that being one thing. And then for all of you, because questions have been asked, we do have a course in German starting 1st of October, investing in stocks, where I will go into all the analysis, etc. And Michael Weiss, who is the CFO of SmartPurse, will show all kinds of different tips and tricks from our common practice. We will have some experts coming in. And this is really designed to go into investing in single stocks and thematic ETFs. Okay, so it's not a beginner's course, but you also don't have to be a wizard. It's really just to come to the next level. And those of you, like Brigitte was asking, would like to kind of come to regular exchange, and some of you already are, join us at SmartPurse VIP. You're more than welcome and happy to hop on the wagon and grow your SheWealth with all of us. And with that, I'm going to pause here and just thank you and see if anybody has any additional questions.